What are wedges? Right. Thank you, Parth. Let me start off with the first question. What are wedges? Now, wedges are falls under the patterns of classical patterns. You know, they are a part of classical patterns. Now, classical patterns, this whole thing of technical analysis of classical patterns can be broken down into two parts. One segment is the reversal pattern, and the other segment, the other set of patterns are the continuation patterns, right? Now, wedges is that form of pattern which actually falls under both. Wedges is that peculiar pattern which at times behaves as a reversal pattern or at times can behave as a continuation pattern as well. So let's see when do they form and how do they act as reversal or continuation. Let's say if you have a falling market which is in a downtrend, a wedge is a pattern which is made up of two trend lines sloping in the same direction. I have two lines over here and both the lines are sloping upside. So I have two lines sloping in the same direction. In a falling market, the wedge is rising in shape. So this is a wedge. So it's a falling market, it's a downtrend. So we have a falling market in our hands, and the wedge that we have is a rising wedge. So when we have a rising wedge, that too in a falling market, in such scenarios, the wedge acts as a continuation pattern. It will act as a continuation pattern. So all that we have to remember is if we see a pattern like this where both the trend lines are sloping up and it's tapering as it moves up and it's a falling market, we have a rising wedge. Prices are very likely to fall further down. In a rising market, the opposite happens. If you have an uptrend rising market, then the shape of the wedge is actually falling, where both the trend lines are sloping down. In such a scenario, prices moves into a small range and the lows and highs becomes coiled. It gets shorter and shorter, the length of the swings. So in this case, we have a rising market and we have a falling wedge. When we have this combination, that is a falling wedge shaping up in a rising market, there's a high possibility of the wedge, this pattern, acting as a continuation classical pattern. So what will happen is prices are likely to continue on the upside. That's wedges as continuation. But wedges also have this uncanny habit of behaving as a reversal pattern also. When does that happen? Let's say we are looking into an uptrend, a chart which is sloping up, and then the prices move into a rising wedge kind of a formation, like this. Now, we can see that this is a rising wedge, but hold on, this rising wedge is shaping up after a rising market. Now, we did that some time back, that in a rising market, if we have a falling wedge, then it can continue. If it's a rising market and it's a falling wedge, then it is likely to act as a continuation pattern. But what we have here is a rising market and we have a rising wedge. So a rising wedge is not supposed to shape up after a rising market, and if it does so, which is the case, then it is likely to act as a reversal pattern. The mirror image of this is when we have a falling market that is in a downtrend and we have a falling wedge. We have a falling wedge like this. In that case, prices takes the shape of a falling wedge after a falling market. So if I have a falling market and then the wedge is falling as well, then it's not going to act as a continuation. On the other hand, high probability it is going to reverse the trend and it will act as a reversal pattern. Wedges are fairly common in the charts, both as a form of, mainly as a form of continuation pattern. Rarely do they shape up as reversals, but when they do, these reversals are very sharp in nature. If you see the 2007 top of our Nifty market, it actually ended because of a rising wedge after a rising bull market. All right, I hope that cleared out your doubts on wedges part. Okay, if the prices is falling with falling volume due to bad fundamental or bad news in the company, then it's bullish or bearish. All right. So if the price is falling, so you have stated a condition, a situation where prices are coming off and the volumes are as well coming down. So volumes essentially play as the degree of participation in the stock. So if the volumes are shrinking, it means more and more people are not interested in that stock at that price. Why will they not be interested? The buyers will not be interested because it's falling and they sense that it may fall further, so they want to buy it cheap. The sellers are also not interested to sell because the prices are probably too low to sell, so that they probably would expect a bounce back. So at that juncture, when the price and volumes are both falling, there's not much interest in the stock, so the stock can go into a lackluster kind of a phase where not much is happening between the bulls and the bears. Whether the fundamentals are bad or the news are bad, that generally follows the price. But to say whether it is bullish or bearish, now what happens is, let's say if you had a very matured long-term downtrend and the stock has probably halved or has fallen more than 60-80%, and then at the fag end of the falling, when the volumes shrink, so let's say the prices are coming off and the volumes are also shrinking, means there are not much sellers left in the market. This may act as a sign of possible bullishness. You have to keep this in mind. It's a possible bullishness and not at all a bullishness. The fact that the volumes have dried off does not necessarily mean that the market will definitely bounce back. For the market after a big fall to bounce back, try to understand that we need some heavy volume buying. So the prices have fallen, the stock has gone cheaper and cheaper and cheaper. So the fundamental players, the valuation players, people who are looking to buy on the supports would want to act. And if they act upon it, the volumes essentially should rise, right? But that happens later. This comes later. First, what will come is the volumes will dry out. People will not be interested in the market at all. It is high possibility that it will go into a range. It's a high possibility that the stock may go into kind of a range. And after some time, the volumes may start to pick up. To answer your question in simple line is, if the volumes shrink with the price falling, theoretically, number one, the downtrend is not that strong. The downtrend is not that strong does not always means that it's going to lead to an uptrend. Wait for some volume spikes. Okay, my voice is not clear. Is it same with the others? Sanjeev, Advait, is my voice not clear to you as well? Or it's only a case for Parth? Okay, it's okay for Advait. So Parth, I'll just suggest just check your headphones. Yeah, it's clear, it's clear. Thanks. Alright, so that was the answer on your volume price in a falling market. So don't jump into buying it because of the fact that the volumes are falling. Probably that's the fag end of the fall. So wait and watch. It's a good stock to keep a watch on. Right. Any other doubt? Sanjeev? You've not asked any question yet, so any doubts from your end? Alright, that's good. So I hope that the videos has sufficed, and I'm making an assumption again that you've gone through the videos. Okay, can you explain the different types of gap? Sure, Parth, I'll do that. So first, let me tell you what are gaps. So gaps are a vacuum where no trades have taken place. So let's say if the price are moving and all of a sudden due to a good news the market gaps up. So it creates a vacuum when no trade has taken place. In that case we have a gap, and in this case it's a rising gap. The same thing can happen in a falling market as well, where there is a gap and due to a bad news the market gaps down. Such gaps are called falling gap. Now these gaps are a function of overnight news that affects the price opening the next day, right? There are essentially 4 different types of gaps. Let me try and draw them within one chart. Let's say after a downtrend, a stock goes into some kind of a pattern, right? And let's say it goes into some kind of a head and shoulder. Not a very neat one, but let's say it goes into some kind of a head and shoulder. So after a downtrend, the market has gone into a pattern. We are inside a pattern. Now within a pattern, you may have gaps. Okay, you may have falling gaps, you may have rising gaps, and all these gaps are taking shape within this pattern. These kind of gaps are called pattern gaps. They are the least useful gaps amongst the 4 types of gaps. So that's pattern gap, not very useful. When you have a pattern like this, you'll be closely watching when market comes out of this pattern and breaks out on the upside, right? When the breakout comes, the breakout essentially means that the prices have come out of the pattern like this. The breakout can take the shape of a gap. What I mean is, the breakout happens with a gap. If this happens, this is called a breakaway gap or a breakout gap. So essentially what is happening is the prices is breaking away from a pattern with the help of a gap. So this is a breakaway gap. These are useful gaps because when you have a breakout from a pattern in the shape of a breakaway gap, generally the market moves in that direction. The third category is when the market is running away, good news tends to come. And in such cases, markets essentially keeps on running away on the upside or on the downside. So that's called a runaway gap. Markets are running away. The last one and the most important ones to keep a watch for is the last gap in the price, which is called an exhaustion gap. Okay, rather than the market going on the upside, an exhaustion gap leads to a fall in the price. So what happens is the market comes down. These are the 4 different types of gap: the pattern gap, the breakaway gap, the runaway, and the exhaustion. So the key thing to understand when we are looking at gaps is how do I differentiate between a runaway gap and an exhaustion gap? Well, pattern gaps are fairly not so important. They are within a range, within a pattern, so not much of a difficulty to judge them. Breakaway gaps are good gaps, and you find them when the markets are coming out of a pattern, breaking away from a pattern. So that's all right also. The tricky part is the runaway gap and the exhaustion gap. How do I know that this gap is a runaway gap and not an exhaustion gap? This could have also been a runaway gap. So the thing to keep in mind is try and understand why is these gaps taking shape. The gaps are taking shape because there is some positive news in the market, in the stock. That's why the market opens up. If the news is strong enough, then it should go further up, right? That's your runaway gap. So after the market gaps up, let's say it's in an uptrend and the market gaps up and it continues to shoot up, high possibility that that gap is a runaway gap and the market is continue to go further up. On the other hand, if the news is good in the stock or in the market gaps up all right, but it doesn't go further up, it just halts. When you do candlesticks, you'll find that it will make spinning top, doji, small body candles with long shadows on the upside. These kind of candles, when they shape up after a gap and the gap has shaped after an up move, then such gap has high propensity to become exhaustion gap. These are the signs of exhaustion. When I say these, the higher shadows are the signs of exhaustion, that the market is exhausted and the smart players are using this gap to come out of the market, to sell out of the market. So that's essentially are your 4 different types of gaps. Right, guys. Next. Sanjeev has said that he doesn't have any doubt, so I hope those videos are good enough to make those clear. We've discussed wedges, we have discussed different types of gaps. I will request everyone who's going through the videos, who are new to technical analysis or financial markets, who are been there for some time, to practice, look into charts. Okay, I had kept a website called tradingview.com/chart for you. It's a pretty good online free website where you can check your charts. So I have the weekly chart of Nifty open in front of me. These are all EOD charts. You can change it the different time frames. So I have the daily chart over here. So what I'm trying to say is, with the theory, with the subject, practice a bit, look into charts, draw some trend lines over here. As you can see, this was a nice little head and shoulder top. So the more you practice, the more better understanding of the subject you will have a hang of. You can look into stocks as well. So let's say if you want to look at ICICI Bank, the same place will let you open ICICI Bank, or I'm an index, that's why. So let's come to all ICICI Bank. So here comes the chart, the daily chart of ICICI Bank. You can change the time frame. So the intention, there must be some data error here because of the dividend or split that it's not adjusted. So what I'm trying to say is there are many free websites. Economic Times also have charting software, TradingView, investing.com, netdania.com, iCards.in. There are many, actually, plenty of them. Use these charting platforms to practice the theory that you're learning. So it will help. All right, going back to queries. Doubts, anyone? Okay, yeah, Sanjeev, I've got it. Sanjeev has asked, is pattern and channel are the same thing? Channel is a type of pattern. So, what is a pattern? Pattern is a price formation on the charts. I'll request everyone to mute themselves. Right, thanks. Pattern is a phase in the chart where it can lead to a reversal or a continuation. So let's say, in a very coarse manner, let's say the market is going up. So why does the market go up? Because the intensity of demand is more than the intensity of supply at different prices. And what happens when the market comes down? The opposite, that is, the supply is greater than demand. Now, this transformation from demand greater than supply to supply greater than demand does not happen or cannot happen overnight. It may take some time for the sentiment of the market to change. And that time, that phase of the market can take a shape of some kind of a pattern. Right? And when these patterns are formed, they are leading to a reversal, right? The market is coming down. So these are reversal patterns. That's a pattern. Let's say a head and shoulder top is a pattern, or a double top is another reversal pattern. A triple top is yet another reversal pattern. So these are all different types of patterns which reverses the market. What is the other type of pattern? The other type of pattern are continuation patterns, where if you are in an uptrend and demand is already greater than supply, and the market continues to shoot up on the upside, that is, it continues to be in a stage where demand is more than supply, still in between there can be a phase where this disequilibrium between demand and supply can move into some kind of a range. It does not come down, it just takes a halt. a pause. These patterns are essentially continuation patterns. Now, continuation patterns can be in forms of triangles and wedges and pennants and flags and many more, but they tend to continue the market. Now, what are channels? The channels are essentially formed by two parallel lines. It can be a little tilted on the down. It can be a little tilted on the up. When channels like this shape up, it's called a flag. When channels like this shape up that are very horizontal in nature, that patterns are called rectangles. So essentially what is happening, we have a bound resistance, we have a defined bound support on the downside, and the markets are not going anywhere. It's within a range. We have to take a look, what was the trend before the market? Was it up or was it down? Most of the time these patterns tend to continue the market. They tend to reverse as well, so we have to keep a close watch on the volumes. So channels are a part of patterns, and the patterns can be reversal as well as continuation.